All right, good afternoon. Welcome to today's live recap. So heading into the open, our intermediate term bias was still neutral bullish and our short-term bias was neutral, which means that we had to be much more mindful of the real-time intraday situation and give more weight to the intraday bias. Now, that being said, the buy side could maintain control above the 67.0575 to 15.75 initial support, which we were also using as the intraday bull bear zone. And then on the upside, we had the pre-market resistance, which had already been tested in the overnight, and then we had the initial resistance zone at 67.72 to 82, which was a bias confirming zone. And of course, sellers could still be active there, but given that the buy side was in control, we had to be open to the possibility of a breakout above initial resistance. And a break and hold above that area would serve as an intraday bullish confirmation, and that could then bring 67, 87 half to 95 half into play, and potentially 67, 99 quarter to 68, 09 quarter, and those upper zones, which were also bias confirming zones, had potential to cap the upside on the day. And then on the downside, if we got a breakdown below pre-market support, that would be the first sign of weakness, and a breakdown below the intraday bull bear would also be a sign that control could be shifting from buyers back to sellers. And if ES then held below the intraday bull bear, then that would tell us that the sell side is now in control. And a break below 66.8875 to 95.75 would confirm that the pattern in play now is a failed or false breakout, and that can then push the market down into 66.52 to 62, which was a bias confirming zone, and buyers could still be active there on first test, and a break below that area on signs of initiative selling would confirm the day's bias is bearish, and that could then lead to a test of the recent lows at 66.13 quarter to 23 quarter, and possibly the 65, 86.75 to 94.75. And the lower the market pushes, the more overextended it gets, and higher the odds of buyers then stepping back in, if nothing else, just from short covering and profit taking. So that was the context heading into the open. Now let's jump into the chart and see how it played out. So early in the session, we can see that buyers are active at the broken pre-market support, which is now acting, pre-market resistance, which is now acting as support. And the AD line, of course, is at a positive value because of the wide gap that we opened on, and the tick is holding above zero. So early in the session, things were looking bullish, and buyers were stepping in at that broken resistance, but there wasn't any clear or ideal trading opportunity because so much of the range potential had already been used up in the overnight. So there wasn't any clear shot at buying the market. And at the same time, because the buy side was now dominant and in control, shorting the initial resistance is not necessarily a automatic type of trade either. If you are shorting towards the back of the zone, there could be some edge there, and it is a bias confirming zone, so it wouldn't be wrong to attempt to short, but just understand that holding above that pre-market resistance means that the buy side is in control and the breakout is in play. And now the question is, are we still seeing signs of initiative buying? Because in order for the market to even maintain those higher prices, we would need to see continued broad market strength, strength in the NASDAQ, and sustained upside momentum. And simply a lack of strength and a lack of continued upside momentum could attract responsive sellers. That is the basic premise of the initiative versus responsive principle that we've discussed in many recaps. So as the market is trading at those higher prices, you technically don't have to really do anything because there's not any ideal opportunity on the table. Remember, the upside might be limited to 67.99 quarter. Now, could you buy the 57 to 67 half area and, just target 87 half and 99 quarter? That's a possibility, but broken resistance doesn't always flip immediately into support where you can just put your stop 1 point behind that broken resistance area and now trade it from the long side. You do need to take additional factors into account. So as an example, if you're buying that broken resistance, you would probably want your stop loss to be behind the VWAP and not necessarily just behind the zone, because we know that one of the telltale signs of a directional market is that it holds on one side of the VWAP. And in order for the market to continue heading higher, it would have to be a directional market. So if we break below the VWAP, that is your first warning sign. So early in the session, I don't think there's really any ideal opportunity, long or short side. But then later, a little bit later in the morning, you can see that the market tries to break out to the upside. And of course, it looks like this is a tiny bar, but if we zoom in and only look at this price action, this is actually a decent size move even over here. So the market tries to break out and fails to do so. So sellers step in at the 67, 87 half to 95 half area. And the other thing you want to note is that as the market is trying to break out above that area, there is a pretty clear lack of momentum, right? So just wanted to zoom in here so we can see the actual bars. And you can see that, the market tries breaking out here, fails, comes all the way back down towards the opening range, and then tries breaking out yet again over here, and again fails to break higher, and then we start to get new tick lows. That's your first indication of a warning sign. It doesn't mean that you have to anticipate the crazy outlier move that we got to the downside. That's not the point. Just take it step by step, right? You don't have to predict what happened today, right? This was clearly a massive long liquidation day. ES is still technically, in the sell-off mode. So the point is not how can you anticipate a 200-point move to the downside or a 250-point move to the downside. The idea is that you want to be aware of range potential. You want to be aware of the initiative versus responsive principle. And at the very minimum, you don't want to get caught buying after the intraday structure and bias has clearly shifted. So as the market is trading up here, remember that we have already utilized and used up a lot of the range potential to the upside, not to the downside, right? The upside could be capped at that 67.99 quarter, 68.09 quarter area, or maybe 13 half to 23 half if the market's really pushing higher with some force. So the upside here is limited, but the downside is not so limited. And again, that's not to say that I saw this coming. I did not, right? I don't think anyone did. And that's exactly the point. These moves happen because no one is anticipating them. People get caught on the wrong side. But do we have principles that can keep us out of trouble, that can perhaps get us positioned on the right side? Absolutely. And these are the same principles that have been discussed in numerous recaps over the years and months, right? For example, day one always marks the breakout attempt, right? Well, today's day one. Day one always marks the breakout attempt, and day two is when we find out if that breakout is succeeding or not. And that's why today's short-term bias was neutral, because today is the breakout attempt. And the question is this now going to be a sustainable breakout, or are sellers going to step in and then turn this into a false and failed breakout? because both are possible scenarios. And that's exactly what neutral means. Neutral means that we are not favoring one side over the other. Neutral means that we are maintaining an extra level of flexibility and agility. It requires the ability to read the market in real time, but not only read it, also adapt and adjust to it. So a neutral bias market is a much more challenging session. It's a much more challenging environment because you have to be able to read the real-time market structure and then also assess what the intraday bias is. And those things are dynamic. They can shift during the course of the day. So over here, you can see that we try to break out again and fail to do so. AD line is starting to go down. The NYC tick is now starting to hold below zero, which means that we are now seeing downside momentum. And if the market breaks below the first hour low, the next significant support, or the support that would matter, is all the way down at the intraday bull bear zone and the support zone below it, which marked the overnight low. So as the market starts breaking lower, right over here, you can either go with the move and use the intraday bull bear zone and the overnight low as possible targets, or at the very minimum, don't try to remain bullish. Don't stay stuck in a regime that is no longer in play, because now the breakout is being challenged. So if this were a bullish day, a successful breakout, we would not even break below the first hour low, right? We would just balance at higher prices and eventually make our way into the 67.99 quarter to 68.09 quarter, and maybe 13.5 to 23.5 if we were seeing some real trend up type conditions. So when the market starts breaking down, the thought that should go through your mind is, one, that the high of day may be in, right? So this is kind of all the market had in it, which means that whatever range potential is left can now play out to the downside, which means initial support can get tested, the overnight low can get tested. And remember that the previous close is all the way down at 66.61 half, and that also may get tested. And that's why, at the very minimum, you want to at least back off from the long side. Now, ideally, when you notice the market breaking down over here, you can get on board, but that, I think, is much more challenging, right, to actually get on board. But, of course, it's not impossible. The market sliced right below the 24-hour session VWAP over here. And, again, the question you should be asking is, does a bullish market or a bullish day look like this? Like, is this what it looks like? Is this what it's supposed to look like? And the answer is clearly no, right? Bullish days hold their first hour lows, and they put in a successful breakout above their first hour high. In this case, we have a failed breakout. Here's the breakout bar, and the break below it is instantly, at the very minimum, a warning sign. And once we slice through the first hour low and the VWAP, now we're probably going to go down and test at least the intraday bull bear zone and possibly even lower. Now the question is, how can we structure a breakdown setup? So if you are noticing the warning signs up here, right, before the market breaks the first hour low, then you have an opportunity to set up a intraday balance breakdown setup, targeting a move down into the pre-market initial support. And I think in this case, because the first hour range has already been established, you can use the intraday bull bear zone as your high probability, and you can use the overnight low area as your final target. So if you are shorting near the actual breakdown over here, and your stop is up at 69.5, and that's a volatility stop that we use for balance breakouts and breakdowns, then this setup alone has over 4R potential. Your scale target is very easy to hit, right? There's nothing here. This is just air, right? There's no support here. And even the pre-market support, remember, is not a bias changing or bias confirming zone. You'll note even the intraday bull bear, by the way, is not technically a bias changing zone. It's a bull bear zone, so holding above it tells us something and holding below it tells us something. But you'll see it says breakdown signals weakness, right? So it's not like a zone that has a ton of trade location edge. Because again, if you start selling off and coming down, then the whole breakout comes into question. And that is part of the reason that we got such a big downside move. These types of moves happen when the market is caught off guard on the wrong side. Buyers had been quite active over the last couple of days, and now that whole thing was unraveling. So as soon as you know that this is a failed breakout, know that the failed breakout is a larger time frame failed breakout. It's a larger time frame bearish pattern. And that can result in a bigger move going the other way. Again, going back to principles. When you have a false breakout, not only can the market then revisit the other side of the balance, quite often you get an even bigger move going the other way. And that's why many times, as long as you can position yourself correctly, failed breakouts can end up being more profitable than actual breakouts or sustainable breakouts. Like if this were a sustainable breakout, the upside could have been limited to 67.99 quarter, 68.09 quarter, or maybe the next zone, right? We had limited upside potential because so much of the breakout already happened. But if the breakout fails, that can be a bigger move going the other way. So that is a principle that we can apply consistently, and it's a principle that we've discussed dozens or maybe even hundreds of times over the course of several years and across so many different recaps. So as the market starts breaking down, I want you to think about whether this breakout is even a sustainable breakout now. And of course, there's a possibility that we might just come down and test the intraday bull bear and then, stabilize. It's possible. That could happen, right? But we don't know that. That's something we'll have to assess in the moment, in real time. That's not something that we can predict in advance. So, at the very minimum, we know that when the market breaks the first hour low, and it's a balanced breakdown now, we're probably going to revisit the intraday bull bear. That's the first notable zone that matters. Pre-market support, we're not going to buy. That's not a strong zone at all. But on the downside, we can consider buying the intraday bull bear, or at least using it as a profit target. So this is how that trade can be structured. It's an intraday balance breakdown setup. And the reason this setup works even better today is that the market is trading way above value. It's way above the prior day's range. There is no conservative support nearby. We had an intraday bias confirming zone here, a resistance area, and another one here, not that far away. Well, where's the first intraday bias confirming support zone? That's all the way down here, 52 to 62. It's 100 points away. So, if nothing else, it should at least give you an idea that if the market does start selling off, the significant support is really far away, and the significant resistance is not. And that's why, buying up here is not that easy or something you even have to do. Some days there's just nothing to do. Some days you just have to wait. And then wait for the market to present an opportunity that, again, has that bigger move potential. On the upside, there's not a big move potential because the majority of the upside has already happened. But on the downside, if we start breaking down, and again, that's not to say that the market had to do all this in a single day. That principle that a failed breakout can result in a bigger move going the other way, that doesn't always have to play out in a single session. The principle can play out over 2 or 3 days. In this case, it played out in a single session because ES was running on such high volume. But as long as you know the principle, at least you can be on the lookout for it, right? At least you can perhaps not get blindsided, because if you remain stuck in the bullish idea or the breakout idea and you start buying every zone on the way down, then it's going to be a bad day for you. All right. And you can't even look back and say, well, trade location equals edge, and I bought the support zones, and that means I had good trade location. You have to look at it contextually, right? If the breakout is failing, then is initial support good trade location? Because, initial support is just a label. They're not all the same. Like you could have an initial support zone that is at the bottom of a multi-day range. That's going to be much more powerful, and that trade location is going to be very consequential. But initial support at the previous day's high is not something that anyone can categorize as conservative trade location, right? You don't have location-based edge at initial support. Like you can't buy the zone purely because you think it's an amazing price. It is not. It's the previous day's high. And it only works if the breakout is still in play. And in order for the breakout to be in play, you need to see signs of initiative buying. And these are not signs of initiative buying, right? So as the market starts coming down, you can see that we do get a bounce, a reaction. And it's about a 20-point reaction off of the intraday bull bear zone. But the tick is making new lows. It's holding below zero. AD line rapidly trending lower. NASDAQ was selling off even more aggressively than the S&P. So when you see that panic selling coming into the NASDAQ and, this trend type of selling coming into the S&P, again, if you bought the intraday bull bear, at least there was some edge there. But once the intraday bull bear gives out, now there's no reason to continue buying. Not because the zone is not good, but because the targets aren't going to be viable anymore. The whole character of the day has shifted. Look at this. Minus 1100 almost on the tick as we're pushing down, as we're breaking below the intraday bull bear. That is not indicative of a strong market. So now if you want to buy, you have to wait for the other side of the range. What's the other side of the range? 65, 86.75 to 65, 94.75. Right? That's the other side of the range. Let's take a look quickly at the bigger hourly chart, right? So when you see this bar, like developing even, right? And we're breaking through the intraday bull bear, we're slicing through it. Well, now do you think this zone, 52 to 62, is really going to matter as much? The whole character of the day shifted. This is a false breakout. And the principle is false breakouts usually lead to a bigger move going the other way. They usually result in a move back to the balance area low. Well, where's the balance area low? 86.75 to 94.75. So that gets tested. And then what's the second principle right after that? Not only do they revisit the other side of the balance, they usually result in a bigger move in the opposite direction. That's what's happening right now. So in the heat of the moment, as the day is developing, these are key principles that you want to remember. And with enough repetition, the principles become an automatic thought. Like you don't have to actually remember them. As soon as you see it, that principle kicks in. Like, okay, this is a breakout attempt. Day one is always a breakout attempt. We're now seeing a shift in momentum, a pretty aggressive shift in price action and market structure. And this is not how a breakout type of market behaves. So at the very minimum, you want to back off from the long side. And ideally, you want to find a spot where you can get on board on the short side. Now, there is still value in knowing that this is a bias confirming zone, even if you bought it. Like, even if you bought it and you lost on it, there's still value in knowing that 52 to 62 is a more consequential, more important area of support, because when it gives out, it can then also act as a more important area of resistance. And that is what plays out later in the day. So going back to the intraday charts, so as the market's coming down, like I said, you don't want to be buying every move. If you're buying, again, the intraday bull bear zone, right, and you're looking for a bounce back up into the 24 to 34 area, so let's set that up as our high probability. So 24 to 34. And the final, let's just set it near our midpoint and VWAP, right? So let's set that to around perhaps 67.40 or so. So something along these lines would be perfectly fine as a structured idea. Even if you left, this final target to be higher at 57, that's still okay. But understand that the high of day is probably in now. So if you're going to fade initial support and the intraday bull bear zone, which again is fine because that's the inflection point, that's the breakout area, then this is how you would set that trade up. You wouldn't be looking for a move back to the highs. At most, you would look for a move back to the first hour low, right? Like at the absolute most, your final target would be the first hour low or a little bit ahead of it probably, right? Something like this. So if you set it up like that, then it's fine, right? You could get that quick little profit, and at least you're not going to lose on that trade. But once the intraday bull bear zone goes, now longs are off the table, or at least they should be, especially because we are selling off on signs of initiative selling. We're selling off on big downside momentum. We're selling off with the NASDAQ putting in a major downside move, right? Like NQ broke below its relevant support around like 10:15. Yeah, like early 10:10, 10:15 a.m. is when NQ had already broken below its overnight support, even before ES got to the bull bear zone. So does that mean you have to short the bounce? No, but it means that you should be very careful on the long side and not continuously press the long side, because now the whole bias has shifted. When the short-term bias is neutral, the intraday bias takes its place. And now the intraday bias is clearly bearish, right? So if you're going to fade it, it has to be at a key area. And if you did fade the 52 to 62 zone, if you attempted a fade over there as well, that's still okay. It's not completely off base, right? So if you did fade this area, okay, just didn't work out, right? That's fine. That's -1R. Not a big deal. And then if you are going to fade, if you are going to catch this falling knife, then wait for it to get to the other side of the balance. Wait for it to get to 86.75 to 94.75 or 70 quarter to 78 quarter. Like something that is now pushing the edge of the other side of the multi-day range. And you can see that there is some decent edge at 88.75 to 95.75, right? If we look at trading the 65, there we go. So you can see this is how Vulcan structures a trade by default, right? It's looking for a move into 13 quarter, final target around 28. That's okay, but I think the final target could be a bit higher. I don't think it has to be 28, but still, like this would be at least a viable idea. It's a more significant area of support. It's on the other side of the trading range, and that alone makes it better location. So even when it comes to bias confirming zones, they are not made equal, right? They're not all the same. Like this is an intraday bias confirming zone too, 52 to 62. This is also a bias confirming zone, but the location difference is massive. And that should be quite obvious that this is going to be a more important zone as compared to this one. This is going to be a better fade as compared to this one. So if you are going to buy, then this is the spot where at least it made sense to buy. And then as the market bounces back up, remember that when you break through a bias confirming zone and it flips from support to resistance or resistance to support, it usually carries more weight too. So in this case, when the market bounces back up, well, this is now broken support that can act as resistance, and it's going to carry more weight. So we can consider even shorting this area. Now, a lot of the range is played out. It's questionable whether ES will, make new lows and really continue selling off or not. That's more of a 50-50 type of idea, but could we hold here and push back down into the lows here? Yeah, that's very possible. Even this zone being tested is very possible. So what we can do then is take the 52 to 62 and flip it to resistance. And as far as our high probability target goes, that should be at the very minimum, I would set it to near the recent lows, right? We're probably going to balance at lower prices. The probability of a complete reversal is extremely low at this point. After this vicious of a downside move, the market has just put a major dent in buyer psychology. So the likelihood of anyone willing to buy at higher prices is very, very low. So we can short this area. And on the downside, like I said, the high probability, I would set it to, at the very minimum, something like 13.25. I think, 29 is a little too conservative there. So I would set it to 13.25. And the final target you can set to the 94.75 zone or possibly even lower. That would be okay. So with these targets, with not even considering a new low, just with these targets, there is 3R potential at 50.75. And of course, once you're in the trade, you can even expand these targets out, right? Doesn't mean you have to take these targets. You might try to get more out of the trade. And that was really it. I wouldn't really continue to engage after that. I think after that, the edge is very questionable. Even, fading this zone, the 70.25 to 78.25, kind of a questionable idea. I can show you what it looks like if you do want to trade that idea. That's basically right here. This is how the trade gets structured, again, by default, by Vulcan, if you are trading that idea. And, this is what that looks like. Long at 77.25, scale at 85.25. That's where it should be. It should be at or ahead of the broken support. The high probability is at 0.75, the next zone, and the final is at the zone after that at 13.25. So this is a good way to structure that trade. And again, there's 3R potential. The difference is that these zones are at the edge of the range. They're at the edge of the multi-day balance area. These upper zones are not. They're in the middle of the range. So if you're buying in the middle of the range, you need to hit a zone where it's so significant that it can reverse all that big downward momentum and completely change the market psychology. That's unlikely to happen when ES is selling off the way that it was. Right? You can see, there's just massive selling taking place. Like, this is a major, major move. So you don't have to be, completely capturing every single move on this type of day, but at the very minimum, you should have enough skill that you can at least recognize that, hey, this is sort of looking like an outlier day. Even the way that we came down into the bull bear zone and then broke below it, that alone was unusual. Like, that's not how healthy markets behave. So as the market's coming down, if you can just recognize that, hey, this looks weird, and this looks unusual. This is not the norm, which means that the normal rules should not be applied, and which means that you shouldn't just be jumping in, at multiple zones. As long as you can recognize that, you're still in good shape. right? And again, it's not about capturing the downside on this type of day. It's really about not getting run over. Recognizing that there are trapped buyers in this market, and at least not being one of them. And that is the other benefit of looking at the market through the lens of market participants. You're always thinking about how various time frames and groups may be positioned and what a certain kind of move in the market means to those participants and how it can affect their positioning and their psychology. And that can then tell you where the market may be going. That can then tell you, what side to focus on and which side to avoid. So on these kinds of days, you have high reward, high opportunity, but also high risk. So this is a high risk, high reward type of day. There's an opportunity to make a decent amount of money, and there's also the opportunity to lose a decent amount of money if you are not positioned correctly or if you are executing in a mechanical way without taking the developing intraday context into account. So, if you bought here, again, not the best of trades, it's counter to the bias, but at least the market's quite stretched by the time it gets here. And just short covering alone can produce a bounce. And then in the closing range, you can see we get very close to this short-term bias confirming zone that we've discussed at least a handful of times over the last few days. So now, as we go into the overnight session and tomorrow, the 65, 36.75 to 47.75 area is going to be in play, and more than likely, this area will get tested in the overnight. And if that area breaks, then I think things can get more bearish, and of course, the sell-off can continue. So as we go into tomorrow, our short-term bias will, at the very minimum, be neutral bearish, and it might even be full-on bearish, because this type of movement is, I think, psychologically quite damaging to the market. And if we take out that short-term bias confirming zone, which we very well could, then I think it's going to be a major hit to buyer psychology. And at that point, we can get continued downside range expansion, and we could just continue to head lower. Let's take a look at the daily chart here. So you can see that, right now we're hitting this major swing low. Over here, we're basically testing this prior balance that we broke out from and, tested earlier. So this is a significant area of support that we're coming down into. And if the market ends up breaking through it, then we might have to revisit the bottom of this balance before we get any notable buying interest. So this is a key inflection point down here. And, I think how the market behaves at that short-term bias confirming zone, 36.75 to 47.75 is going to be very telling. Below that, we have this HVN, and then we have another support area at 65.0875 to 21.75, which is also a intraday bias confirming zone. So I think in the overnight, these are going to be key as far as support goes. And on the upside, the broken support areas can act as resistance, with the more significant one being the 52 to 62 and the 70 HVN. You can see this is really where we got acceleration on the downside, right? You can see we just kind of blast right through this area. It's a low volume area. And that's another principle that I think I'd like to remind you of, is that when the market slices through an HVN, where the high volume node on a multi-day time frame becomes a low volume node on the day time frame, that is usually a major tell of directionality. So the fact that we just sliced through 66.70 without any kind of pause or balancing or slowing down of price action, that's a major tell that this is now a significant shift in market sentiment. So that's the other reason you don't want to be buying, every zone on the way down today, because just everything was adding up, and the bearish signals were just stacking up as the day went on. So I hope that the recap was educational, and the only way that we can do better the next time is to have a very solid understanding of what happened this time. Otherwise, we're bound to repeat the same patterns and mistakes the next time a day like this comes around. Now, days like this don't come around that often, but when they do, they can either provide you with a lot of profit, or if you don't know what you're doing, they can inflict a lot of damage, right? It goes both ways, risk reward. So it is worth your while to really study this kind of day, even if it only happens once in a while, because it has high risk and high reward potential. So as we go into overnight, if this is a move that's really going to stick, then you want to see it holding below those two key support areas, the 52 to 62 and 64.75 to 74.75. This is a key spot. And if the market is really weak, which so far it seems to be, then you want to see it holding below even 86.75 to 94.75, or at the most 13 quarter to 23 quarter. Right? So if we're holding below 13 quarter, 23 quarter, things are still bearish. If we're holding below 65, 86.75 to 94.75, then assume that the sellers are clearly in control, and instead of guessing whether buyers will step in here, you can just step aside and wait, because right now these zones are prone to being tested below, right? So instead of jumping in and kind of, being the sacrificial lamb, you can just wait, right? What's the worst that can happen? That we reverse here? So what? Then you'll buy a pullback. I think the fear of missing out is the number one thing that gets people into the worst of trades, because they just can't stand the thought of missing that move. Like, what if we turn around? So what? Who cares? There's going to be another opportunity in like another 30 minutes, maybe 2 hours tops. So if you can just deal with that fear of missing out, because I think that truly is one of the root causes for getting into very questionable trades, because it's very easy to convince yourself that you're doing the right thing and, get into questionable ideas just because, well, what if? It could be a home run. It could be a 5R trade. And that's why we never use risk reward as the only reason to get into a trade, right? Risk reward is used as a filter. It is never used as the sole reason to get into a trade. You always have to also take the probability of that zone holding or that trade working out into account. You have to trade for expectancy, not for reward to risk. So as we're going down here, can buyers step in? Yeah, it's a short-term bias confirming zone, and this is a pretty decent zone too, and especially in the overnight, we might turn around here. But after this kind of day, the buyer psychology is going to be quite weak, and usually you don't get V reversals after this kind of move. Usually after this kind of move, if you hit a floor, if you hit a zone that is strong enough, you might balance at lower prices, but touching this zone and then rallying back up, that is low probability. Now, anything can happen. That's the nature of the market, and that's why you never want to have so much certainty in what the market is going to do. Right? Even though I've been doing this for over 15 years full time, and if you count the part-time stuff, it's probably over 20 years at this point, I still don't have like a high degree of conviction that the market must do X or Y. You always want to have some level of skepticism in your own ideas and understand that at the end of the day, the market moves based on the actions of its participants. Right now, I'm listening to an audiobook, the latest one from Andrew Ross Sorkin called 1929, and I recommend it. I think it's a great book. I'm still kind of in the middle of it, but it just kind of reinforces certain ideas that we already have. It just kind of shows you that the experts don't know where the market's going to go, right? The institutions, the banks, the media, even the Fed, they don't know. They don't have as much control over the market as people might think. So if those guys don't have control over the market, if those guys, who have access to billions and trillions of dollars don't have control over the market, who are you and I, to think that we can, with 100% accuracy, predict where the market's going to go? I'm so glad that we trade on the day time frame, because the market is much more predictable on the day time frame than, in my opinion, on a much, much larger time frame, right? The longer the time horizon, the more variables, the more possibilities, the more actions people can take. But on the day time frame, on that smaller time frame, the market psychology, the buyer, the seller psychology is much more predictable. The moves are much more predictable. So regardless of whether you did well today or you got caught on the wrong side today, the only thing you can do if you want to stay in this business is learn from it and then move on. There's no need to ponder over it either, by the way. Like, learn the lesson, try to ingrain it, and then restart the next day with a fresh slate. Don't allow the winnings from today to influence you tomorrow. Don't allow the losses from today to influence you tomorrow. Try to come back with a clear head, a blank slate. And if you can't, then take a couple of days off. Next week is a holiday week anyway. And actually, on that note, next week we will not have live recaps. So next week is Thanksgiving in the US. I'm going to be on vacation with my family for the entirety of next week. The trade plans will still be posted, the zones and the plan. But the recap, especially a live recap, we're not going to do because I'm going to be on the other side of the world. And with the time zone difference and everything, live recaps are just not going to be viable for me. So maybe it's a good time to take a break anyway. So those are thoughts. Recap's already running into 47, 48 minutes. So I'll cut it off over here. I could probably continue talking for the next 30 to 40 minutes easily. But yeah, let's see if there are any questions that can be covered that haven't already been covered, and then we will wrap up. Okay, Michael's saying, under which circumstances would it make sense to be buying any of the supports when assessing before the open? What would we need to see to buy any of the relevant supports before the major sell-off, assuming it wasn't an outlier day and before the first hour breakdown? So if the market did not, let's say, even get to this upper zone, let's say that we hit initial resistance and very early in the session we pulled back into the pre-market support or the initial support, in that situation, because it's in the first hour, these would be better areas to buy because the first hour range is still being established, and this might end up being, the bull bear zone might end up being the first hour low. And that means we can still go back up to the first hour high and try to hit those more extended objectives. So in that case, it would be okay to buy. I mean, even today, if you bought the intraday bull bear zone, like I said, it's okay, it's fine. Like, that is the key inflection point. But if you're saying in the first hour, what are the zones that I could buy? In the first hour, I think you could buy all three of these zones. If these are being tested in the first hour, and again, it's not just that, but how are they being tested, right? Are we hitting initial resistance and then reversing on this type of momentum? Well, then you might want to be more careful. But if we hit the zone, pull back to pre-market support, and that's when the tick is testing the zero line, that's a buy. Let's say we don't hold here, we get a reaction here, we go down to the bull bear zone, tick is hitting -5, 600, that's a buy in the first hour. But that's in the first hour, and that's with some caveats. Um, okay, so Michael, I've already talked about the 6652 to 62 as a valid short. Yeah, I think that'd be fine because even if the range has been used up, you can still balance at these prices and still get 3R, right? You saw how I structured the trade. The range did not have to expand to give you 3R. So that's why this would be a good sell. Let's see. Um, Saad's asking about NASDAQ, kind of the equivalent support in NASDAQ. Let's take a look at the daily chart. On the NQ front, by the way, also note that NQ did not take out the highs from here, from the 17th. It still held basically that resistance, and this area was also 61.8 of the entire swing. But as far as the equivalent in NASDAQ, we're kind of there already, really. I mean, this is the balance breakout area. Like here's the low that kind of results in new highs here. NQ is already there. So NQ has been leading to the downside recently. It has been weaker than the S&P recently. We've talked about that, I think, in several recaps. So NQ is pretty much already there. It's already testing the equivalent of the short-term bias confirming zone. And if this area gives out, then we might have to go down to the balance area low again to find the next set of buyers. Like I said, this kind of market activity, this kind of sell-off, it just put yourself in the shoes of buyers or someone who's bullish on the market. It's just going to be difficult. The psychology and the psychological damage, I think, is difficult to reverse. Like if you are a buyer even, are you going to have conviction to hold it? Probably not, right? Like you're not going to have the faith to sit through any longs. You're going to be getting out early. So even if you do buy, even if buyers do step in, they're not going to have the conviction to see it through, which makes it difficult for the market to go higher because that lowers the odds of initiative buying. And in order for the market to put in a rally, it's not enough to attract value seekers and responsive buyers. Responsive buyers only really help at the edges of balance areas, right? They help when the market is severely oversold and they kind of cushion the downside move. But their effect quickly evaporates because they're not willing to buy at higher and higher prices. So the driving force behind rallies are not value seekers and responsive buyers. They are initiative buyers or trapped shorts, which can add fuel to the upside move. But given this chart right now, which looks pretty ugly, I would be careful on buying the market right now. Let's see. Kobe saying I shorted 67.88 to 90 preemptively for failed breakout potential versus first hour high, risking 1R, but my targets became too conservative for 3R. With the benefit of hindsight, these targets look like I didn't catch too much of the move. In real time, what could I have recognized? The minus 1,000 tick into the bull bear. The breaking of the bull bear is really the more significant tell here, right? So, I mean, of course, the tick is a major sign, but I'm assuming you were already out of the trade by the time ES hit the bull bear, which is still a great trade, right? You still caught 3R out of it. So it's still a very good trade. Don't think that you didn't do well on that. So Kobe's saying he was out by 6-7-20 and caught 3R. Yeah, so the break of the bull bear is, I think, what really sealed the deal here. What really kind of set the sell-off and accelerated it. So you would have to be willing to hold. And of course, in order to do that, you also have to be okay with giving back open profits, right? No risk, no reward. So, of course, as the market is selling off, at the very minimum, you already knew like the high of days probably in, you caught it at an amazing price. You still caught a nice size move to the downside into 6-7-20. I mean, that's really well done. But if you want to maximize it, then recognize the shift in the tick. But realistically, until the market took out the bull bear, you wouldn't really um, be able to just have a ton of conviction that the market has to continue going down. I think keeping an eye on the Nasdaq can be helpful for you because NQ was leading to the downside, so it took out its own support before ES took out the bull bears, so that could be a helpful thing for you to help you hold part of the position for a bigger move. But even getting out at the bull bear, nothing wrong with that. I think that's still a solid trade. All right, guys, that's it. So we'll wrap up with that. Thank you for attending. I hope you guys did well. I hope the recap was educational. I would recommend watching it again once the recording is up. Again, these days don't happen that frequently, but when they do, they can have a major impact. The capital gain or loss is one thing. I think the psychological gain or loss is more significant on this kind of day. And once you extrapolate that out to the wider market, you can see why it makes sense to now be, at the very minimum, quite cautious, especially given that we're heading into a holiday week. All right, guys, we'll end with that. Hope everything went well, and as always, we'll be back at it bright and early tomorrow morning. Take care and enjoy the rest of your day.